Hello, everybody. Welcome to the National Real Estate Post. Frank Gray here, hosting today. We have Barry Habib with us, which we're happy to have. I got to tell you, though, Barry, one thing that these guys need to think about is checking out That Broker Show. Do you know why?
Because you're on it.
Yeah, and what we do is we pick a news story, and then we explain in that news story like how you can use this story to prospect, and then we even give you a free downloadable marketing piece that you can stick on Facebook or Instagram that goes along with the whole concept. Like it's really cool. It's all free. So That Broker Show, click the banner you see over on your right and get started with That Broker Show. Fascinating, isn't it?
I like it.
You know, it's nowhere near as fascinating as what's going on with the feds right now, though, is it?
Well, yeah, there's a lot going on with the Fed. There's a Fed meeting this week. So there's a lot of talk about will they begin to taper. So a few things to understand is that the Fed, they claim they're buying $40 billion. Mortgage-backed securities, we've talked about this before, it's more than $100 billion a month in mortgage-backed securities. So when they start thinking about tapering, they're not going to taper the reinvestment portion. That's, somebody pays off their loan because of a refi, sale of a home, or the principal payments that they receive. What's going to happen is that'll be intact. It's the $40 billion of extra over and above that reinvestment as part of the $100 billion that they're buying total, that they might taper a little bit, but I don't think they're going to do it this time around. And here's the reasons why. Number one, the last jobs report, and they've made this correlation with jobs, which in my opinion is a mistake, but they made this correlation with jobs. And the last jobs report was pretty lousy. We got that for the month of August. We received that the first Friday in September. You might recall that number was a poor number. So that's going to put the brakes on any type of idea in tapering, probably in and of itself. But then we get the CPI numbers, the Consumer Price Index, and that number showed inflation declining. So instead of inflation being 4.3% on the core year over year, it went down to 4%. Fed likes that. But here's the thing with that. Don't be fooled. You'll start to see that go back up, up, up. And here's why. When the inflation numbers come out for each month, what it does is it takes the last 12 months. So a new month comes in, it replaces the 13th month. Now, the 13th month, the inflation number for that month was very high. So this number comes in and it reduces it. But here's what's about to happen. The months that will be replaced, the next 4 or 5 months that will be replaced, the numbers that came in for inflation a year ago were very low. So even if we get a little hint of it, which we probably will, you'll likely see those inflation numbers rise. And so for now, for this month, the Fed has cover. They say, we don't have to do anything. Inflation's coming down, jobs report's weak. But then there's something else that's going on here. And it's a story that we've been covering, and I know that you're aware of it too, but it's something fishy at the Fed. So there are 4 Fed members in particular. So there is Fed President, there's Barkin, there's Fed President Rosengren from Boston, there's the Dallas Fed President Kaplan, and then there is the Fed chair himself, Jay Powell, who have all now come into question on some assets that they have, holdings that they have of things that they were buying at the Fed, like mortgage-backed securities and things like that.
The personal, it's for them personally.
Personal accounts.
Okay.
Now, look, if you're a member of the Fed and you had some of these things before, I mean, where are you going to put your money? So maybe it's okay. And I think that for Jay Powell, it's okay. I think probably for Barkin, it's okay. But we find out that Kaplan has had some trades that have gone on. But the most egregious one is Eric Rosengren, the Boston Fed president. Now get this. He made 37 trades of mortgage-backed securities in multi-million dollar amounts. You're buying a lot of mortgage-backed securities.
Dude.
Should you be trading them in advance of those purchases?
Dude.
That smells. Now, according to the way that the laws are set up for the Fed and what they're able to do and not able to do, it doesn't appear that there's going to be like jail time, but there are big calls for these people to be, called out on it. What I think is going to happen is I don't think they're going to get in trouble, but a lot of the laws that were there were before the Fed started buying assets like this. You know what I'm saying? Right. So nobody kind of contemplated that when they created the laws as to what the Fed members could hold. So chances are we'll probably see some revisions to the laws of what Fed members can hold. Now, look, we don't want academic Fed members. You want some that have market experience. But it seems to me that 37 multi-million-dollar trades of mortgage-backed securities, that is pretty egregious, and that seems like that just stinks to me. It seems like it's blatantly wrong, and I think this guy, you know, it ethically definitely is in the wrong position here to be a Fed president. Now, what that also means in the big picture, tying this back up, is look, these are human beings, and if you're distracted like this with this kind of stuff, you probably aren't going to make any big decisions on making some changes. So all this to say that based on the unemployment report, based on the inflation, and based on this distraction with what's going on at the Fed, it seems to me that they'll kick the can down the road this week and they won't taper. Now, the bond market already is kind of liking stuff like this. There's been another story that broke, and this is something that we really have to watch out for. So it's Evergrande, this Chinese company. It's the second largest property developer in China. So they got into a lot of debt, like so many companies have. But listen to this: they're $300 billion in debt. How do you get $300 billion? That's a crazy number, right?
Crazy.
So they've got these interest payments coming up, and they don't think they can make their interest payments. So think about the two-way domino effect. First of all, multi-million dollars in interest that's expected to be received. If you don't get that money, that potentially jeopardizes your businesses, right?
Yeah.
If you're the recipient of some of this interest.
Right.
But then this company is not the only company that is going to be in a position where they borrowed so much money that maybe they're choking on it and they can't make the interest payments. So could this be the canary in the coal mine? Could this be something where there's going to be other issues out there? And that's why you saw the stock market take a hit. That's why you see like even the cryptocurrencies taking a hit, because this is not good. Some people have named it like a Lehman moment. You know, you remember when the financial crisis, how this, like the Lehman moment came out. Now, could China step in and make it like an AIG where they bail them out?
Yeah.
It could be, but this could have some big consequences. It's a story that not a lot of people are talking about, but I think it's something we need to keep our eyes on, because this could have some ugly circumstances out there. Now, from a mortgage side, this could be one of the things like we were talking about. You remember, look, bro, we talked about this quite a bit, and saying that the debt levels, what have we said always about debt that people don't realize? Heavy debt slows economic activity. We're seeing that now, keeps inflation at bay, and interest rates tend to gravitate lower because of heavy debt levels. This could be one of those circumstances, and hopefully it doesn't unwind in this awful way, but this could actually help push interest rates lower. We're already starting to see some market reaction in the bond market.
Fascinating. Interest rates lower. It just never ends for the mortgage industry, man. You know what I mean? It's been years of just wonderful rates, and just every time we think something's going to knock them into the sky, no, there's something else that comes along. No, let's bring them back down. Just fascinating.
Yeah. Well, we talked about this. We said that we see rates being, we told you there was going to be a little bit of a bump up. There was a little bit of a bump up, nothing crazy. It was short-lived, but then of course, here we are again, right? It's probably going to head lower. Not in a straight line, but probably lower.
So this week, the real focus though is the Fed meeting, right? That's
there's a lot of housing data this week too.
Yeah.
So a lot of housing data. I suspect the housing data is going to continue to be strong, although the media doesn't get it. They will continue to, just like they've been doing. I mean, Diane Olo's been at this since 2013, talking about a housing bubble. And
pooping on housing forever. Yeah, sure.
You were at my presentation. It was so nice to see you in Napa when you saw me list all of the headlines from
that was great.
And CNBC, every single one of them
like that.
Just 2014, 15, 16, like many of them each year, just talking about housing's bad, rent, don't own.
Yeah,
the boom is over, the bust is here, the bubble's happening for years.
Yeah. So
of course they're going to have a negative spend, but it's going to remain strong.
All right. Well, good enough. Thanks for all that. It's a lot of information today, but it was fascinating. Very, very good. So I'm sure the viewers are going to appreciate that. Guys, take it easy. Have a great day. Look, I'm going to put a link to MBS Highway down below so you can stay in touch with Barry absolutely daily and get this type of information every single day. Make you an absolute advisor, which is what you want to be. So with that, you guys, leave us your comments down below. Forward, share, and subscribe if you're meeting us for the first time. And we'll catch you later here at the National Real Estate Post. Thanks, Barry.
Thank you.